Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
All right, good afternoon. How is everyone today? You haven't done the quiz yet? Yeah. Okay, so I'm going to begin today by talking about the fact you have a quiz this week, yes? And the quiz is on the material we covered last week only. Okay, so anything to do with futures and forwards that we learned last week could be covered in the quiz. All right? It is a calculation quiz, I think, for the most part. Or anyway, you should be taking your calculators along, okay, to class. Next week, we have a quiz again. The quiz will be on the material that we cover today and Friday, okay? And then guess what? We have another quiz after that, which will be on the material we'll cover next week. Okay, is everyone clear? Yes? Otherwise, make sure you go to your enrolled tutorial for the quiz. Otherwise, your quiz will not be counted. Are there any questions at this stage? I'm trying to think of things that I should be telling you, but I had nothing to say, I don't think. Please feel free to email me, come and see me in my consultation, guys. We're getting towards the end of the course now. I'm getting some questions, not many about futures and forwards yet. I think that will be after the lecture today, perhaps. But the point is that moving forward, we need to start revising the rest of the course, okay, for the final exam. I haven't set the final exam yet, but obviously I will do so soon because it's only in just over a month. Is that correct? Yeah? Okay. All right. Great. So where should we begin today? Well, last week we introduced you to derivatives, and by a derivative we mean a financial instrument which derives or gets its value from the underlying asset. So I introduced you to Bob the farmer, who sells wool or wheat, depending on how I'm feeling for the question or the example, and we discussed how a farmer might be exposed to certain risks, primarily price risk, because a farmer will have some sort of crop that they're going to sell and at some point in the future, and they're worried about price fluctuations. Obviously, if the price goes up and they're selling the crop in the future and the price goes up, that's a good thing. But they're more concerned with the fact that the price might drop. And if the price drops, then they're going to get less for what they need to sell. Okay, so I introduced you to the idea of a futures or forward contract, whereby what we're dealing with is a contract between two parties which locks in a price today, but the transaction's done at some future point in time. Okay, now the point of the futures and forward contract is that you are locked in. Okay, you have no choice. There's no backing out. Once you enter it, unless you default, you have agreed upon this transaction, okay? Unless you sell out of your position in the situation of a futures contract. We're going to continue on with futures and forward contracts today. And what we're going to do is we're actually going to talk about valuing futures and forwards contracts, okay? And in doing that, we'll learn what's known as the cost of carry model. And following on from the cost of carry model, we will identify situations where this model does not hold. Okay? Now, what I mean by that is if you have a formula and everything equals, the left-hand side equals the right-hand side, then your relationship holds. Okay, now what's going to happen, there will be situations where the cost of carry relationship does not hold. And actually what that indicates to us, remember we're greedy, is that there is some sort of mispricing because the relationship doesn't equal. Okay, and if there's some type of mispricing, we are actually able to generate profit. Okay, so we'll learn how to do that today. If we have time, and that's a big if because I don't want to rush that, and also we do have Friday with the workshop, we'll start to talk about an options contract. Has anyone ever heard of an options contract? Even just heard about it. You might not understand it, but you've heard about it. Like some of you, yes. Essentially what an options contract is, and don't get too worried at this stage because I'm going to go through it in a lot of detail over the next week or two, is unlike a futures and forwards contract, an options contract, like the name, can give one party in the contract a choice. Okay? And what the choice is the choice is whether they want to buy or sell at that predetermined price. Okay? Now with futures and forwards, remember you're locked in. Yeah? So you agree today, transaction occurs in the future. With an options contract, there is one party to the contract who can determine what the price is that they're going to transact at in the future. Okay? So this party has got the choice as to whether they wish to transact at the pre-specified price on the contract, or they don't use the contract price and they go and buy and sell in the actual spot market, the market price. Okay? So, let's say we have Bob the farmer, yeah? Bob the farmer has now decided he's going to enter into some sort of options contract to sell something in the future, okay? And he decides he's going to sell for $1,000, yes? So he has a choice whether he wants to sell in the future for $1,000 or not. It's now the future. The market price is $980. Is he going to sell in the market or use the contract? He's going to use the contract because he wants to sell high. If the market price was $950, say, he wouldn't have used the contract and he would have just sold in the market. Okay? So you can see that this options contract can have, not definite, can have some flexibility for one party in the contract. Okay? And that's why it's called an option, because you have a choice, or someone has a choice. And so I'm going to introduce to you those types of derivatives, the options contract, hopefully at the end of today, but potentially on Friday. Okay, so we just got to make sure that we understand the difference between forwards and futures, which locks in the price to buy and sell. You can't change anything, versus an options contract. And we'll discuss that in more detail. But the fact that you're already answering the questions correctly makes me think I have to write a really hard final exam. No, I'm joking. Everyone wakes up, final exam? What did she say? Final exam. You'll miss my bad jokes next semester. You will, I promise. Okay, so that's just what we're doing today. In terms of what is a forward contract, what is a futures contract, we've spoken about this at length last week. I spent some more time in the workshop going through what the differences are. What's a long position of a forward contract? What are you doing? Buying, short position, sell. How many people remember short equals sell because they both start with S? Anyone? I do. Okay. We also spoke about marking to market. Remember we had to have the margin account. You had an initial margin per contract. If the initial margin was, say, $1,000 and you had 4 contracts, that would mean that the initial margin would actually be $4,000. Okay, so just keep those sorts of things in mind. We spoke about the margin call. If the balance of the margin account went below the maintenance margin, at or below, you will receive a call from the exchange to top up the funds back to the initial margin. Okay, so just remember all those things. If you have difficulty with the marking to market questions, my advice to you is most people find it easy to do the long position. Okay, do the long position and then you can reverse the cash flows for the short position because we know that the long and short position when you add them up should equal 0. Okay, overall net gain and a loss or gain. The last thing we did was we had a look at the profit diagrams for the long and short position. Okay, everyone okay with those? Yes, no, maybe? We've spent a bit of detail with that in the workshop as well. So I'm kind of hoping we can just move on, if that's okay with everyone. Obviously, if you're struggling, please let me know. I will go through it in the workshop on Friday. I don't mind, okay? If I have time, I will help you. I will do it for the whole class so everyone can see it again. I do actually care about you guys, even though I write hard exams. That's tough love, yeah? That's what I tell my children, tough love. I actually spoil them. Okay. All right. So what we're doing today is we're going to value a forward contract or a futures contract. And before we begin, we need to just understand that when we go about valuing a forward or futures contract in practice, we say that they're the same thing, they're equivalent. And the reason why we do that is, well, the first thing we assume is that interest rates are constant over the life of these contracts, okay, in this course. And then in addition to that, what we assume or what we can understand is if interest rates are constant and you have a futures contract or a forward contract on the same underlying asset with the same price in the future to transact at, with the same quantity, the same quality, everything's the same, then they actually have the same value. Okay? So that's what we're going to just make sure we understand as is the assumption for what we're about to do moving forward. And I think that talks about it in that slide. Okay? So we're going to value futures and forwards in the same way. Okay? They're equivalent. All right. So, how are we going to go about valuing the forwards and futures contracts? And I've got to just also give you guys a warning. This is one of those lectures that students' brains sort of explode. Well, not explode, implode. I don't want to see exploding brains, okay? But it's a tricky one. You will have to go and do some revision, all right? But I will go through it again and again over the next few weeks. What we need to understand is when we want to value forward and futures contracts, we can replicate their payoff by taking positions in the spot market, and this will become clear when we actually start doing examples. And in addition to this, we can realise, and we all understand this, if you can get to an answer or an outcome in more than one way, they should be equivalent. Okay? And what I mean by that is, we'll see this in a second, is if we need to obtain some wheat or wool in the future, there's two ways that we can go about obtaining this wheat or wool. Okay, let's just do one, Jenny. Let's say wheat. There's two ways we can go about getting this wheat. Okay, so if we need wheat in 3 months, we all know about this futures contract on wheat now. So we could enter into a futures contract on wheat to lock in a price today to buy in 3 months' time. Okay, that's one thing we could do. How else could we go about obtaining this wheat? We could buy the wheat today, couldn't we? Right? Then we'd have it in 3 months' time. But I don't know about you, if we're going to buy wheat, it's going to take up a lot of area. So what we might want to do is buy the wheat and store it for 3 months, yes? And we don't have any money, perhaps, so we might borrow the money to buy this wheat and store it. And then at the end of 3 months, we'll take the wheat out of storage and we've got the wheat in 3 months' time. Okay? Now you can see the outcome for both scenarios is exactly the same. Yes? So we could enter into a futures contract to lock in a price and get the wheat in 3 months' time, or we could buy the wheat today, store it, and we can have it in 3 months' time. Both has the same outcome. If they both have the same outcome, then they should be worth the same. The value of both these strategies should be the same. Because if it's not the same, we could create profit. We could buy whatever's cheaper and hold it, or sell whatever's more expensive and create a strategy to actually make money. Okay? So these two outcomes have to actually equal each other. And that's what we're going to formalise in the next few slides. So the example they have here is wool. We need to buy 5,000 kilograms of wool in exactly 3 months from today. Between now and 3 months, what we're concerned about, if we're buying wool, we want to buy low, is we're concerned about the price going up. Okay? So what we can do is we can buy this wool in two ways. The first way, as we just discussed, but I used wheat, now we'll use wool, is we could go long in the futures contract or a forward contract, okay, on the amount of wool, 5,000 kilos, that we need in 3 months' time. We can agree upon the price, we do nothing today, and in 3 months' time, irrespective of what the market price is, the underlying market price, we will purchase this wool at the futures price that we locked in. Okay? The second situation that we could do is, well, we could say that we have no money today, so we could borrow some money, yeah, and we could buy that 5,000 kilograms of wool, and then we could store it in a silo, or no, wool would be a storage facility of some kind. We could store it, and that storage cost, we're just going to formalize it, is known as the cost of carry. Cost of carrying the wool, you can think of it like that. It's denoted by Q. I don't know why. Q. Okay? It is. That's what it is. Okay. So we can store it, and then in 3 months' time, we'll take it out of storage, we'll pay back the money we borrowed, and we'll have nothing but that wool. Okay? They're both equivalent. So we can formalize this in an equation, and for some reason, the equations aren't actually written for a lot longer in the slides. But essentially what we have is, and you can see from, it's within these dot points, the futures price, F, we always use F. Even if we're talking about a forward, the formula is never expressed with a K. Not often. It's just always F, okay? If you put K, because it's a forward contract, that's more correct, okay, and good for you. But I'm not going to stress it in the exam if you put K instead of F or instead of K. Okay, that's not necessary. So we have the futures price should equal the spot, because that's what you end up, if you think of the two outcomes. The first outcome is that you lock in the futures price to buy. The second situation is that you borrow some money and buy the wool today. The price of the wool today is the spot price today, which is S0. Okay, so that's why it's S0. We have 1 plus the risk-free. The risk-free is the rate that you're borrowing this money at. Okay, we have the cost of storage, Q, to the power of T. Now, this form of the cost of carry model is for any type of commodity. Okay, so wheat, wool, etc., etc. Okay, cattle. I think we're doing a beef question later. Yes, where's the beef? No, we're doing a cattle question later. Okay, this is a commodity. There is a second version of this formula, and that's when we're dealing with a stock or an index. Okay, and that's slightly different. And we'll talk about this in more detail later, but just so you have it in your notes, we have minus D. Okay, and this is for stock or an index. And the reason why it's minus D, I will explain later, but it's got to do with dividends. D stands for dividends. Okay, and it will make sense when we actually look at some of the strategies. So here are the two formulas we're going to be using for the majority of the day, the rest of the day. And what we want to do now is actually talk about the fact that sometimes this relationship doesn't hold. Okay? So the way the lecture notes goes on to explain this is they basically say we know that these two outcomes should equal one another. Okay? So what happens if it doesn't equal one another? What happens? And what happens is that we can actually identify some sort of mispricing and make some money from it. Okay? And that's what we're going to do. So what we're going to do is we're going to have a look at the situation where the relationship doesn't hold. So what we mean by that is okay, so our relationship doesn't hold. Okay? And what we also need to remember is buy low, sell high. Okay, and we'll see that in a second. And the other thing I think we need to remember to be able to do these questions successfully, and this is just equipping you with what you need moving forward, is we need to know the payoff from forward or futures contracts. Okay? Can anyone remember the long payoff? ST minus F. And what about the short? F minus ST. Now, the reason why I'm telling you this is because we're about to create these arbitrage strategies and identify profit, and knowing these payoffs make filling in the tables a lot easier. Okay, and you must have seen on the slides we have these tables. Okay, so that's what we need to successfully do these questions. So the first one we're going to have a look at is the scenario where the futures price is greater than buying it today by borrowing and storing whatever the underlying asset is, the wool. Okay, so if you identify some sort of mispricing here, one side's greater than the other, there's a few things you first have to remember. The first thing we assume with any arbitrage opportunity we do in this course is you start with nothing. There's no money in your pockets. I don't even have pockets today, okay? No money, okay? Just remember that. That's the first thing you have to remember. The second thing you have to remember is your buy low, sell high. Because what you need to identify is which side or which outcome is overvalued relative to the other. Okay, so which one's overvalued, which one's undervalued. When you can identify which one's overvalued, you will know that you should buy or sell it. You should sell it because it's overvalued. And whatever side is undervalued, you should buy. Okay, and if you remember that, then it's pretty difficult to make too many mistakes. I would like to say no mistakes, but too many mistakes. So in this scenario here, which side's overvalued? The futures. The futures price is overpriced, overvalued. So what should we do then? Sell futures. So this is, I'll say futures is overvalued or overpriced. Therefore, sell futures. What does sell futures mean? Does anyone know what that means? It's the same as saying go short in a futures contract. Okay, it's exactly the same. And I used to always just say sell futures, and then last semester or the semester before I was teaching a class, and they're like, what does that actually mean? And for me it was obvious, it just means you short the futures contract. But students didn't realise that that's what it was. Okay, so sell futures is just another expression for saying go short in a futures contract. What does that mean? What are you doing if you go short? It's a short position. What are you doing? Selling the underlying. Do we have the underlying? No, we've got nothing in our pockets. Okay, we're creating an arbitrage strategy here. We're not trying to protect our future sale of wool. We're literally identifying a mispricing and trying to make money. So we start with nothing, end with something, hopefully. Okay, so what we've identified so far is that the futures is overpriced and we should short futures. So basically what we're saying is we should sell the wool in the future, but we've got no wool today. All right, but what's the right-hand side telling us? Undervalued? Yes? Okay, so the right-hand side is undervalued. And if something's undervalued, what do? Therefore, buy, because it's relatively low. Do we have any money to buy the wool? No, so what are we going to do? We're going to borrow. And if we borrow money, we'll have to pay back the risk-free, yes? And what we're going to do is immediately buy the wool at the market price, and we'll store it. And if we store it, we're going to have to pay storage costs, which is Q, and we will do that for however many months this futures contract's written on. Okay, let's have a think, because all of a sudden it sounds like a pretty little picture. What we're doing right now is we have identified that the current market price is undervalued for wool, so we're going to buy it. We don't have any money, so we go borrow some money, buy the wool and store it. At the same time, we lock in a price to sell it in the future. That price is overvalued. Okay? We do nothing until termination, expiry. What do we do at expiry? We reverse the strategy, yes? And what I mean by reversing the strategy is we've locked in a price to sell this wool. We sell the wool. We're going to get some money. We'll get some money from our margin account, and we'll sell the actual wool in the marketplace, just like we did with physical settlement last week. What else do we have to do? We have to pay the storage costs. We have to pay the risk-free. But at the end of it all, what should we have? Nothing but some money. Yeah? And this is the point. If the relationship doesn't hold, you should be able to execute some type of strategy whereby at expiration you're left with some money. If the relationship holds, the cost of carry holds, and there's no mispricing opportunity. Okay, so we get into an exam, and I give you a question, and the question says, does the cost of carry model hold? And you put the numbers in, and you see that it holds. Is there any arbitrage opportunity? No, the relationship holds. I did that for an exam once. Everyone thought there must be an arbitrage strategy because I put it in the exam. And so they created very interesting things. Okay. So the point is, if the relationship holds, if that one left-hand side equals the right-hand side, no arbitrage. But we're going to spice it up, and there's always going to be arbitrage, pretty much. Okay. So let's go through this now. So, if it's undervalued, we're going to buy, and what we mean by that is we'll borrow money, and the amount that we will borrow will be the market price, because we need to borrow exactly how much it's going to cost for this wool in this example. We will pay interest, which is the risk-free, and cost of storage. I'll put carry, because that's what we call it, which is Q, and that's to store the asset. And then what we will do is we'll buy the asset. How much is the asset going to cost? The market price. Okay, so you can see here that it's pretty self-explanatory what's going on, in the sense that we've identified that the futures price is greater than the right-hand side, so the futures price is overvalued, so we want to sell futures, or in other words, lock in the price to sell this underlying asset in the future. If we lock in a price to sell the asset in the future, we need to have the asset to sell in the future. Okay, so that's why we end up doing the other side of the strategy, which is borrowing some money. The amount we have to borrow is the market price of the wool today, S0. We immediately buy this wool. It will cost us S0, which is an outflow. Okay. Following on from that, we'll store the wool. We'll have to pay back the interest, and in 3 months' time, we will sell the wool, receive an overall higher price, pay back the money for borrowing and also the storage costs, and we should be left with some money. Okay? Easy. Kinda. All right. So in the situation where we have the futures price is greater than the right-hand side, we will have a maximum arbitrage of the difference of the futures price less, I'm calling it the right-hand side, the buy now option. Can I say that? Okay. That's our maximum arbitrage. And this will be a lot easier when we actually look at numbers, and we'll do that shortly. But what we can see is when you're doing one of these questions, you should always obtain this amount, this maximum arbitrage, because we're not taking into account things like brokerage and things like that in this course. We're keeping it very simple. Interest rates are constant, no transaction costs. Okay, cool. All right, so what we need to do now is actually show how this strategy works, and we require in this course, and actually it goes on into applied derivatives, to formulate tables to show the strategy and how it works. Now, I've also got to say to you that what we're doing in this course is known as discrete. We're looking at a discrete version of this formula. A continuous version would be far more realistic, okay? And you look at that when you go into applied derivatives. Okay, so we're keeping it simple at this stage. Simple. Simple. All right, so let's have a look at this table. We have the strategy. Okay, we'll have the initial cash flows, or initial costs, you could say, and we'll have the terminal cash flows. And the terminal cash flows are the ones we're interested at expiry. Okay? Now, you will be required to draw these tables, so please don't forget that. So what we're going to do is we have identified this mispricing. The futures price is overvalued. So what we're going to do is, first off, I guess, we will immediately borrow some money. And the amount that we will borrow is the market price of the wool, yeah, plus S0. At the same time, we will buy the wool. Can I put buy asset? Or I'll put buy asset so we can keep this general. Okay, this works for any commodity. Okay, and the amount, the amount that it's going to cost us is exactly the amount that we borrowed. Yeah, and the last thing is, now that we've got this wool, okay, is we need to ensure that we lock in that overvalued futures price to sell the wool in the future. Okay, so we will also go short in the futures contract. How much does it cost? 0. Remember how to enter into the contract costs 0 for a forward or futures? It's the marking to market is purely just the intermediate gains and losses, which is only done because futures are exchange traded and they want to ensure that there's lower cases of default. But in reality, there's no initial cost for a futures contract or forward contract. So we have 0. So what you can see is our initial cash flows equal 0. All right. Now, if you have any other value at the bottom of your initial cash flows for questions on this, you haven't done it quite right. Not wrong, you just haven't done it quite right. Okay. All right. So you always have 0. So the initial outlay for this strategy is nothing. You're taking no money out of your pocket. Okay. All right. So then at expiration, what we're going to do is reverse the strategy. Okay, now if we borrowed the money, remember not only will we borrow the money, but we'll store the asset once we've bought it, okay, which means we're going to have to pay back S0, 1 plus the risk-free, plus the cost of storage to the power of t, where t is in months, okay, or periods of years or whatever the case, it's discrete. All right? So that's what we're going to have to do. Perhaps I shouldn't have written that line first because we actually have no money at this stage to pay back. All we've got is some wool. Yeah? So what we're going to do is we're going to sell this wool. We have to sell the wool at the market price. What is the market price? Anyone know? It's ST. We don't know what it is. It doesn't matter because we've locked in the futures price. So in reality, the first thing we'll do is we'll go and sell this wool in the market. Yes? We'll also have a payoff in our futures contract. What is the payoff from a short futures position? F minus ST. Yeah? That's why we need to know them. Very important. The payoff from our short futures is F minus ST. If you have a look, if you at the bottom 2 rows, plus ST is what we're going to receive from selling the wheat, or the wool, sorry, and our payoff is F minus ST. If you add those 2 cells together, you see immediately that you've locked in the price of F to receive for this wool. Okay. Once you've received all that cash, we know that F is greater than the right-hand side. So paying back the underlying asset price initially with some interest to the bank and also the cost of storage is going to be lower than the amount we received from locking in the futures price. Okay. So therefore, what we're left with is F minus S0, 1 plus RF, plus Q to the T. And what you can see is that is our maximum arbitrage amount. Okay? All right. So, let us have a look now at a numerical version. Because for some reason when we start putting numbers in, it seems to be a lot easier. Maybe it's because there's no F's and ST's or not as many. Okay? So what we've got is this example. It's beef. I told you it was beef. I want the example. Did I miss it? Here. This is the example I want to look at. We'll go back and forward a bit today. Okay? Suppose the spot price of beef is 350 cents. Now, this is a kind of a question you could get in an exam or a quiz. All right? Depends how nasty I'm being. Yeah? So we have the spot price of beef is 350 cents per kilo. The 6-month futures price is 380. So we know that T equals 6 months. We know that the futures price is 380 cents per kilo. And we've been told that the riskless rate of interest, so that's the risk-free, equals 5% per annum. And the cost of storing beef, I hope you're okay, whoever that was, is 6% per annum. Okay, and basically we've been asked if there's an arbitrage opportunity. Okay, now this is a typical, seriously, a very straightforward type of quiz or exam question. Again, it's really useful to just write down the information. One of the things to note is I've seen this before, because I know you guys love interest rate conversions. Sometimes you're given nominal rates or periodic rates. Okay, it should be an effective. Did you hear that, everyone? Should be an effective. So make sure you check that out. Okay, so how would I go about doing this question? First of all, plug it into our cost of carry model. That's the first step. If the relationship holds, no arbitrage opportunity. If it doesn't hold, okay, we've got some money to make. There's mispricing here. So we have F equals S0, 1 plus RF plus Q to the power of T. We have, this is what I used to do in high school. Did you guys ever do this? LHS, left-hand side? Well, anyway, bear with me. F equals 380, I'm old, we know that, 380 cents per kilogram. The right-hand side equals S0, 1 plus RF plus Q to the power of T, which gives us 350, 1 plus 0.05 plus 0.06 to the power of T. T is 6 months, so it's a half. Okay? And then we tap that into our calculator and we get 368.75 cents per kilogram. Now, you don't round in these questions as well. I think the lecture notes have rounded, so just don't round when you get to quizzes or exams. Okay? Until the end. Yeah? Okay. So what we can see here is that the left-hand side does not equal the right-hand side. And what that means is that F, which equals 380 cents per kilogram, does not equal S0, 1 plus RF plus Q to the T, which equals 368.75 cents per kilo. So we can see that F is greater than S0, 1 plus RF plus Q to the power of T. And what we're doing here is we're basically just doing exactly what we did in general, but we've actually got numbers this time. Okay, so it's going to be the same strategy. So what we can see, what's overvalued? Futures. So what are we going to do? Sell futures. What else? Borrow money. Yeah, this side's undervalued. Overvalued. Okay, so we're going to sell futures, which means go short in a futures contract to sell beef in 6 months' time. Okay, do we own the beef? No. What do we have to do? Buy the beef. Yes? Do we have money to buy the beef? No. So what are we going to do? Borrow. Oh my gosh, you guys are on it. Love it. Borrow money. How much are we going to borrow, guys? S0. What's S0? We've got information here. 350 cents. I honestly wanted to say 350. I really did. That's embarrassing. 350 cents. So we're going to borrow money. We're going to borrow 350 cents per kilo, or just 350 cents. We'll just assume we're doing this for 1 kilo. Obviously, if you identified it, you'd do it for as many kilos as you possibly could. So we have 350 cents. We're going to borrow that money, and then we're going to buy beef. I just want to write buy beef. I think that's awesome. Which is going to be minus 350 cents. And we're going to store the beef as well. Just remember that. Okay? And that's going to cost us the cost of storage. So here's our strategy. What is our arbitrage profit here? Well, we know it's the difference between F minus S0, 1 plus RF plus Q to the T, which gives us 380 minus 368.75, which gives us 11.25 cents per kilogram. Okay? So that's the number we're looking for at expiration, at the bottom. Yeah? Everyone cool so far? So what's going to happen? Here we go. We've identified there's mispricing. The futures price is overvalued. So in doing that, we notice that we should be selling this beef in the future. We don't have anything in our pockets. We have no money. So what we've identified is that we can go borrow some money, pay the risk-free to borrow the money over the 6 months. We buy the beef, we store the beef and pay storage costs, and we enter into a short position in a futures contract to sell the beef in 6 months' time at that higher overvalued price. That's how we start. 6 months later, we do nothing in between, maybe feed the beef a bit, feed the cattle. Well, they will do that where we're storing it. 6 months later, we take the beef out of the storage, or cattle, sorry, out of the storage, and we sell it at the market price. Okay. In addition to that, we'll have a payoff in our futures position. It's a short futures contract, so the payoff is going to be F minus ST, or 380 cents minus ST, whatever the market price is at expiration. And then all we have to do from there is pay back the amount we borrowed with interest, plus the storage costs from having the cattle in the storage facility for 6 months. So we're left with nothing but hopefully 11.25 cents. Okay? Obviously, we do this thousands of times, so we would have much more money than 11.25 cents. Okay. All right, so let's draw up this table. It's obviously too easy, yeah? I'll make it harder next week, promise. I just want a reaction. That's all. Okay, so we have our table. It's pretty straightforward. What we're going to do is we're going to borrow some money. And the amount we're going to borrow is 350 cents, because that's how much 1 kilo costs. We will immediately buy beef, which costs us 350 cents, and we'll enter into a short futures where the underlying asset is beef, and that will cost us 0. Once we've bought the beef, we store it. Okay, so there will be storage costs involved. Our overall initial cost is 0. Okay. Next, in 6 months' time, we take the beef out of storage. We will have a payoff to our futures position. It's just a payoff. Remember, we learnt that last week. And the payoff is F minus ST, because it's a short futures position. F, 380 cents. The market price at expiration, we do not know. It doesn't matter what it is, because we've locked in this futures price. Okay, it will be higher, though, the futures price, that is, than the market price. We still haven't actually sold the beef, so we go to the appropriate place in the market and we sell all this cattle and we'll receive the market price for it. Okay? You can see that they offset each other to give us the locked-in price. Finally, what we have to do is pay back the borrowing costs, or the amount we borrowed, plus interest, and the cost of storage. So it'll be minus 350, 1 plus 0. What was it? 5%? Yes. 0.5 plus 0.06 to the half, which actually equals 368.75. So you can see what we're left with is 380 minus 368.75, which equals 11.25 cents per kilo. Okay? Pretty straightforward. Kinda. Okay. So what happens in reality is, first things, if we identified it, it most probably wouldn't exist anymore by the time we've identified it. But just say miraculously we did, we would keep trading this until it no longer existed. And what we mean by no longer existed is that the futures price would correct itself, it would start to drop, and the underlying price would start to increase more than likely. Now, it might not be in proportion, it might be one more than other, but eventually the cost of carry relationship would be re-established. Okay? And that's what's going on here. All right? That's why this cost of carry model must hold. And it makes sense. If you can get to the same outcome in two ways, the value must be equal. Okay? And that's what we're getting at here. So once we've done that side, which is where the future price is overvalued, I guess the other thing we need to consider is the situation where the futures price is undervalued. Yes? The futures price is undervalued. And so what we get to is that with these cost of carry arbitrage questions, there's only going to be two different scenarios. The case where the futures price is overvalued and the case where the futures price is undervalued. Okay? So you can only have those two types of strategies. Where they can differ is that you might have a commodity or you might have an index. We just did the example with the commodity. When we do the next example, we'll look at an index. Okay, so you can see the slight difference in the formula and how it works. Okay, but before we do that, let's just have a look at the undervalued strategy in general. So what I'm getting at here is, just say we have the cost of carry relationship, and I'll use commodity just for consistency, is this, and we're talking about the scenario where the futures is undervalued, which means our right-hand side, our buy now strategy, is overvalued. What are we buying and what are we selling? We're going to sell something now. What are we selling now? The underlying asset? Yeah, we'll talk about that. And what are we doing in the future? Buying it back? Yeah? So are we going long or short in the futures here? Long. When something's undervalued, you buy it. Hence, you'd go long in a futures contract. Okay? So if futures are undervalued, we think of it being cheap to buy. It's saying that the futures price on this asset is low, okay, in the future. We can lock in a price that's cheap to buy it back at. So when you have an undervalued futures price, you will buy futures, okay? And that's the same as saying go long in a futures contract. That's what it's saying, okay? All right. What does that mean? That means you're locking in a price today to buy some asset at some point of time in the future. What did I say like 25 minutes ago? We assume we have nothing. Yes? We have to buy something back in the future. All right, keep that in mind. What about the right-hand side? It's overvalued. What are we going to do? Sell it. What does that mean? We're going to sell this. So it's suggesting to us that we sell the underlying asset today. It was wool, wasn't it? We're going to sell the wool today. What, do we have it? No. Ooh, we'll borrow. What does that mean? What does that called? Oh, I love that word. Thank you. Short sell. We've heard this word before. Students hate it. They cringe. I shouldn't say hate. My daughter just reminded me. Don't say hate. Don't say hate. Students dislike this word, short sell. Basically, short selling is when you borrow an asset you don't have and you sell it immediately. Why do you do that? What do you think is going to happen to the price? It's going to drop. So if you go and borrow it off someone, sell it at its high point, allow it to drop, and then buy it back at a cheaper amount, you've made profit. Now you can see that this strategy is starting to do this. We're going to sell this underlying asset, the wool, today, and get lots of money for it, but lock in a price to buy it back so that we can give it back to the person that we borrowed it from. Okay? This is where I always say, I go to my grandma, I go, hey Granny, I need some wool. She gives me the wool. She says, give it back to me in 6 months. I go, great. I go sell the wool because it's overvalued. What happens then? I invest the money for 6 months. What am I going to earn? The risk-free rate. Because I don't have that wool, guess what? I save storage costs for Granny or for myself, okay? And then what? I've locked in a price to buy this wool back at a cheaper price. In the future, buy the wool back and give it back to Granny. Okay, now Granny could be your best mate. Granny could be your worst enemy. It doesn't really matter. But the idea is that you're borrowing this asset from someone and selling it at its highest and locking in a price to buy it back cheaper. So, same thing applies. We start with nothing, we borrow this asset, we sell it immediately. We take the money, we put it in the bank, earn the risk-free rate. Because we're not holding this asset anymore, we save storage, so it's inflow of Q to us. Just like the risk-free is an inflow because we've invested the money. And we sit there and wait, but at the same time, we've also entered into a futures contract to buy the asset back. Okay, expiration comes of the futures contract. We will go and buy the underlying asset in the market, but there'll be a payoff to our futures contract. What will the payoff be? ST minus F. Okay, now when you add that together, you've locked in a price of F to purchase this underlying asset back from. Okay? How do you pay for all this? All the money that you've invested and all that storage costs you've saved will give you sufficient funds to do those transactions. And yet you will still be left with profit at the end of the day, and you will return the asset to the person you borrowed it from too. Okay? So all these strategies are circular in that they're self-fulfilling. They start with nothing and you end with profit. There's no assets lying about or anything like that. It's great. Nice and simple and straightforward. So what we'll do, it's 12:54, is we'll have a break till 1, and then we'll come back. We will do this table in general, and then we'll have a look at this other example with the stock index, and then we'll go on from there. Okay? It's now 12:55 because I wasted 35 seconds. Go, go, go. 5-minute break. Go, go, go. Come talk to me if you're having issues, or just come talk to me.
But maybe at the end of the class. Louise, I don't know. She's always like over there. Lunch? I have kind of breakfast lunch. I don't know. Yeah, and brunch. Why? Do you have lunch? Oh, in the morning, I see. You're gonna buy what? Monitor? A monitor? For your laptop? To have like another. Yeah, it's better. I mean, you can deal with 2 Excel spreadsheets at the same time, for example.
Then again, whenever, because I noticed my neck hurts recently. Then I realized there's this table height in my chair. You know, you're always looking down when you're reading.
Maybe you can maybe you can put some books.
Yeah, but then I have to type like this. Right? So I think I just buy a monitor. So.
Yeah, it's better.
Yeah, then I close my laptop. I have a keyboard and a mouse.
Yeah. Okay, I got my mouse.
I have a keyboard.
I hate, I like my keyboard, but I don't like my mouse, the laptop like that stuff.
Yeah.
I really don't hate it. But definitely a monitor is, it's a good investment.
I'll buy a 4K monitor.
Okay.
Because then it's good
I got a monitor like this, not for 4K. Yeah, but it was better, especially with the Excels.
Yeah. What size of monitor you get?
In Chile, back in Chile, I think I have like a TV, but like a big one, and a monitor like this. Also. Hey, Louis, what are you doing?
Sweet.
Good on you. But maybe let's do it at the end. I think we're gonna start. I don't have a pen. Okay.
Useless.
Sorry.
The study led me to find the RSA room.
Yeah, here's just my sign and date.
Yeah, your name and date.
Name?
Name?
Signature. Sign on the same line.
Name is
Maybe let's
Solo.
do it first.
The RSA room is so difficult to find. It's like a maze.
Oh, let's see. Is this a PAP? It's like all the way
I almost,
courtyard, right?
yeah, I almost turn several lefts, turn several rights, and then find that.
Oh, just that I didn't see your message till late because I was talking with a friend.
Yeah. I was so bored yesterday. I was like,
Yeah, I talked like 3 hours by Skype.
yeah, it's good.
So what did you do? Did you finally get a coffee?
So
or?
I eventually got a book. I finished my book, The Alchemist.
Oh, The Alchemist.
Yeah,
Okay.
so I finished the book in the student center. I was just reading there. Because
Oh,
I
nice.
didn't want to see my room. There was no computer. What do I do?
The Alchemist.
So how is your computer?
The screen has a bit of problem, so they're going to replace the screen and then give the computer back to me in 4 days.
For free
Okay.
or? Oh, cool.
My-
Yeah, Mac. You can have like internet.
All right.
Thank you. I will.
Such awesome questions in the break. I love a good question. First things first, a couple of people have asked me about this. I don't know how to write because I added some questions to this tutorial, and in the process, this is not question 4, it's question 6, okay, which is the question above, so just remember that. The other thing is that you should all know what one SPI futures contract point is worth. We did it last week. It's $25, okay? That's a convention you need to know, yeah? Okay, so I'm going to close that off. Thank you for that, because I have had more than one person ask me about that, so it's good that I remember. You guys haven't been using the forum, the discussion board as much, because usually I get notification that you guys have been writing on it, so I can come and write some solutions. You guys should use that if you can, and you feel comfortable to ask questions to your peers, but I always come in and check that it's right as well. So, I mean, there's another point of contact for me and tutors and your fellow peers. The other thing I wanted just to speak to you about is a very good question in regards to the risk-free rate. We're making the assumption here that as individuals we can both borrow and lend at the risk-free. Not generally the case. Usually we borrow at a higher rate than we would invest at. Okay, but for the course, for ease, that is what we do. Okay. The other thing I had, which is directly related to what we're about to do now, was when we're doing short selling, I used the grandma reference because my grandma wouldn't charge me to borrow her wool. Okay. In reality, there would be a cost generally for borrowing someone else's asset. Okay, you would have to pay them something. Okay, and I'm not just talking about any dividends that they should get if they were holding the stock or something like that. I'm actually talking about like almost paying for borrowing the asset. Okay, so, but we don't assume that in this course. We're keeping it very, very easy. Okay, all right. So we were at this stage. What we want to do now is, one other thing. When we were doing the beef example and we storing the beef, you've got to remember that the underlying asset, someone asked me, and it's a good question, the underlying asset is actually cattle, okay? And what we're doing here is we're letting them roam free in some sort of farmland and we're paying for that in that period of time. If it was wheat, we'd mostly store it in some sort of silo or something appropriate to the underlying asset. So keep that in mind as well. Okay, so what we've got here is a situation where the futures contract is relatively undervalued. So we've already identified that we're going to buy futures, which means go long in a futures contract. We've also identified that the payoff is ST minus F. Okay, we did that ages ago. All right, so what happens with our sell side, the right-hand side, is we are going to short sell whatever the asset is, the wool, yeah? So we borrowed the wool off Grandma and we sell it in the market. How much are we going to get for it? The market price today, yeah? And then what we're going to do is we're going to invest. And so we'll invest the market price today. We will also, and so therefore we'll earn the risk-free, and we'll also save on storage. Okay, I guess the best way, it's a tricky one to explain, but essentially you're not paying it out, or alternatively you're getting refunded because it's been paid for the whole year. Okay, so you're getting some money back for it, okay, because you're not using the facility. Yeah? All right, so once you've done that, all good, we buy our futures. So there's our strategy. Let's draw the table. We have strategy, initial cost, terminal cash flows. Okay, so let's think about this. We've identified this mispricing. We identify that the underlying asset is currently overvalued. So what we do is we short sell. And if we short sell it, that means we're borrowing it from someone and selling it immediately in the marketplace, and we will receive the market price. The market price today, which is S0. We'll immediately invest the money and we will earn the risk-free plus the storage, because we're saving the storage. So we're going to invest and put it in the bank. So it's minus S0. At the same time, we've got to remember that we have to buy back this asset that we just sold to return it to the person we borrowed. So we're going to enter into a futures contract to buy the asset at some point of time in the future. Okay, and we do that because the price that we've identified is relatively undervalued. So it's going to be cheaper to buy it back. So we buy or go long in a futures. I'll put long because you guys know what long is, I think, better than buy. I don't want to confuse you. And the cost of the futures contract today is 0. Now remember, we could say forward contract here or futures. They both have the same value if they're on exactly the same underlying asset, maturity, etc., same contract specifications. So we can see that the initial cost is again 0. Okay, so with these strategies, the initial cash flows should always sum to 0. Okay, which means the money that we're going to make, the arbitrage, the profit, will always occur from the terminal cash flows. All right, so what happens at expiration? Well, first things first is that we'll have a payoff to our futures contract. The payoff, because we're in a long futures, is going to be ST minus F. Okay, we also know that we will have to go and buy this asset in the market. Okay, the wool that we have to return to Grandma, it will cost minus ST. You can see that the market prices at expiration cancel out, and what we're left with is that we have to buy this back for the futures price. Okay, how are we going to actually do these transactions? Just prior to getting our payoff and also buying the underlying asset back in the market, we will Sorry, I put it in the wrong column. Oh, typical Jenny. Let's do that. Better. Before we do these transactions, we will retrieve the money from our investment, our bank, okay, and we'll get plus S0, plus the interest that we earned, plus the storage cost savings. And then if you add this all together, what you'll be left with is S0, 1 plus RF, plus Q to the T minus F. Now this is our maximum arbitrage opportunity. And the reason why it's like that is if we go back to our expression, we can see that the futures price is less than the right-hand side. So this value here will always be greater than 0. Okay. Now, if you get into an exam and you do one of these strategies and you get to the last line and you see that you get a negative, please don't give me a negative. Okay. Please, we want to make money. Let's make a whole lot of money and then we can be philanthropic and give all the money away. All right, but for now we're making, yeah? So if you get a negative, you've most probably done the wrong strategy. Okay, so quickly figure it out. All right? All right, so that is it in general. What I want to do quickly is the other example, and the other example is in relation to a stock index, I think. Is it a stock index or a share? A share. And the reason why this is a nice example is because not only does it do that the futures price is undervalued, so we're going to go long in futures, but it also uses the other version of the cost of carry model with the stock. Okay, so we'll talk through that. So we've kind of been through that, we have been through that. One thing we need to talk about is this, and I'll do that before we do the example. This strategy assumes that we can short sell whatever the underlying asset is. It's not generally the case that we can short sell every underlying asset. Okay? For this course, we can. All right? But in reality, not so. But the point is that if there was a mispricing in the cost of carry relationship, people would still execute arbitrage strategies. They would just have to be slightly different. And they would be slightly different in the sense that the people who would be executing these strategies would actually own the asset to begin with. Okay, and then they could still take it out and make money. For this course, however, we're going to assume we can short sell everything, and so it makes our life a lot easier. So realistically, the number of different strategies you have to learn is 4. Yes? 2 for a commodity and 2 for a stock index or a stock or whatever. Okay? But you should try and understand the process and actually what's going on, because then it doesn't matter what I throw at you, you'll always get it right, which we want. Okay, so what we've got here is our cost of carry model, and it slightly differs when we're dealing with a stock index or a stock, because what we can see here is we've actually got a negative cost of carry, okay, and so there's a negative sign, negative D. Now, the way that I think about it is, if we go to this strategy we're about to do again, but let's think about borrowing a stock from Grandma. I go to Granny, and I say to her, I saw her on the weekend though, she's 88, she's amazing. And I say to her, lend me some BHP stock. I think that's what the question is. And she lends it to me. She's still going to ask me for those dividends, right? Because when you short sell or borrow an asset from someone, they actually still are in the situation where they own it, as in they believe they own it. So if they earn dividends, they're going to expect you to pay the dividends to them. Okay? So say we have I borrow these BHP stock and I sell it. At some point before I bought it back, BHP might pay a dividend. My granny is waiting for those dividends. Okay? So what I do is I give her the dividends. That's an outflow from me to her of minus D. Okay, so it's a negative cost of carry, hence the negative in the formula. Okay, so that's the best way to think about it, I think. All right, let's have a look at this numerical example. We have, not beef, share. We have BHP Billiton. We can see that the current market price is $26. The futures contract is saying, well, the time is 6 months. Expiration, the futures price, is 25.90. Okay? If the prevailing bank bill rate is 7% per annum, bank bill rate, what is that? Anyone know? I know you're reading the rest of the question and going, well, logic is that it's the risk-free. Yes? It's basically a short-term, most really a 6-month bank-accepted bill or something like that, or a bank bill. Okay? And so it is the risk-free, but just so you know that when you get in an exam and see bank bill, you don't freak out what it's referring to. And that's 7%. And the dividend rate equals 5%, telling me I've got a meeting to go to. I won't be going, don't worry. It's 5% per annum. Okay, so we've got all the information that we need here. Again, it's a bit confusing because most of the time when we deal with dividends, we don't deal with it as a percentage. But for this formula or this relationship, we need it as a yield over a year. Okay, all effective rates. If I was to give you a nominal, if I was to give you a periodic, you need to convert it to effective. We got it? We're on the same page? Good. All right, so let's have a look at the relationship. F equals S0, 1 plus the risk-free minus D to the power of T. Okay, just to make it a little bit more speedy, because I know you're getting sick of me, we have the futures contract equals 25.90. Our right-hand side, S0, 1 plus RF to the minus D to the power of T. You guys can all plug that in. 26, 1 plus 0.07 minus 0.05 to the half. And that gives us 26, okay, as it says in the slides. All right. To be honest with you, in an exam, I'd prefer to see the solution written like I'm doing it on my iPad. Maybe a bit neater. I know I'm terrible, okay, but it's much easier to see what's going on. What we can see here is the futures price is less than the right-hand side, and the arbitrage, well, arbitrage will exist because the relationship doesn't hold. And the maximum profit, or the profit that we should be obtaining, is the difference between the right-hand side and the futures price, which gives us 26.26 minus 25.90, which gives us 36 cents. Okay? Okay, so that's all well and good. Now, in an exam, these questions are usually worth about 8 marks. I don't know, about 8. This part here that we've just done is like 2. Okay? The majority of the marks is from doing the table correctly. So keep that in mind. It's really important you understand. So what are we going to do here? We can see that the futures price is undervalued, so we will buy futures. That basically means we're going long in a futures contract. We are going to buy the underlying asset in 6 months' time. We don't own the asset today, okay, but it's relatively overvalued. So what we're going to do is we're going to short sell the BHP stock today. We'll get a sum of money. We'll invest it in the bank. Yeah, pay any dividends back to the person we borrowed it from. Earn the risk-free, and at the same time, enter into a futures contract to buy the stock back in 6 months so we can return it to the person we borrowed. Round trip. This is a round trip transaction. Okay, so let's do that. So we're going to buy futures, we're going to short sell BHP. That's the stock that we have identified is mispriced, and we're going to invest. Okay, so in terms of the table, we have strategy, we have initial cash flows, and terminal cash flows. Okay, so we're going to short sell BHP. From the information that we had, BHP was currently $26. Because we're short selling it, it's an inflow, 26 plus 26. What we're going to do is we're going to invest, okay, that $26. In doing that, we will earn the risk-free, and we will have to pay out the dividends over that 6-month period. Okay, and because we're paying them out, it's a negative. All right. The final thing we're going to do is we're going to go long in a futures contract to buy BHP in 6 months' time, and the futures price is $25.90. Okay. Initially, though, it doesn't cost us anything to enter into the contract, and we can see that our cash flows initially cost us nothing. We start with nothing, we enter into this strategy, and we've got nothing. We're just waiting now. In 6 months' time, what we're going to do is we're going to buy back this stock to return to the person we borrowed. How does that work? We'll have a payoff in our futures position. The long futures contract is ST minus F, yes. At the same time, we'll actually purchase the stock physically in the market, which will be at the market price minus ST. That's how much it will cost us. And we will be able to do these transactions because we'll pull the money out of the bank and we'll have earned the risk-free over that period of time, less any dividends we had to pay to the person we borrowed the stock from. Once we've reversed those initial transactions by the transactions I've just mentioned, we'll have some money left over, hopefully 36 cents. Okay, so we have to, first things first, we went long in our futures, so there'll be a payoff in our futures account. The payoff is going to be ST minus F. F was 25.90. Okay, so what we're trying to do is lock in a price of 25.90 to buy this BHP share back at. Okay, that's what we're doing here. At the same time as the payoff, the money from our bank account that we invested will basically expire or mature, and we'll take it out of the bank. The amount that we will have is the $26 plus any interest less the dividend yield that we actually had to pay back to the person we borrowed the stock from. So that's going to equal 26, 1 plus 0.07 minus 0.05 to the half, which gives us 26.26. Okay? And then finally, now that we've got that money, we will go and purchase the BHP share in the stock market for the market price, minus ST. And what we can see is that cancels, and we're left with 26.26 minus 25.90, which gives us 36 cents. Now, in an exam, you don't need to write all this detail that I've written here, okay? I'm just doing it so that you know where I'm getting the numbers from, all right? So you can write 26.26 there, and I'd be happy as long as you've calculated 26.26 up here somewhere, okay? So I can see the working at some point. Does that make sense? I'm just giving you too much so that when you're freaking out and studying, you know where it's coming from. Okay? Cool. All right. Easy. Cost of carry. We love it. Yeah? Now, I've got some good and bad news. That's the end of futures and forwards for now. The bad news is that, you know how we had cost of carry? When we deal with options, we have something called put-call parity. It's so much harder. Okay? So what we're going to do for the remainder of today is start to talk about options, and next week we'll look at put-call parity and arbitrage with options contracts. Okay? It's great. This is a really cool part of the course. The week after that, we'll have a look at risk management, which it's tricky, but I'll try and make it as easy as possible. Okay. So what we have seen in the last week and a bit is that we can use these futures and forward contracts to lock in prices. We'll find that in a couple of weeks' time, we'll also use them to lock in interest rates and exchange rates, okay, which is great for risk management, which I spoke about briefly last week. I remember that. What we're going to do now, however, is start to think about options contracts. And the great thing about options contracts is that it actually does give certain parties who are involved in the contract a choice. Okay, now let's think about it. If you're a farmer and you are locking in a price to sell your wool, you'll be really happy if it turned out that the market price dropped, okay, and you managed to lock in a higher price, right? But you'd be really upset if you locked in a price and it ended up that the market price was higher than what you locked in. You've lost money, okay? And this is the situation that, obviously, because we're greedy, financiers realised that there needed to be some type of new instrument where people could get the choice, okay? And what that means is that we could have a situation where we could either choose the locked-in price or we could go with the market price, okay? And that's our options contract. So what we're going to do is we're going to actually talk about the options contract. We have to be really, really, really confident with the differences between options relative to futures and forwards, and also what we call them and what they're doing, okay? So this is critical. The next couple of slides and the next couple of maybe 20 minutes or so is pretty critical. Okay, so I always get to this point, I'm like, where do I start? Because I don't like starting with what the slide's talking about. So you just have to excuse me while I'm trying to make this as easy as possible. When we were talking about forwards and futures, the price was denoted by F. Yes? F for futures, K for forwards. I'm like, is that right? No, it's right. Okay. When we're talking about options contracts, the price that you possibly could transact at is denoted by an X. Okay? So when we're dealing with options, we will be talking about, oh, highlighter. Nice, Jenny. Options. We are talking about what we call an exercise price. Sometimes we call it the strike price. Okay? And it's given by the letter X. Okay? And this is the price that is agreed upon today that we may transact at a future point in time. Okay? It's denoted by X. It could also be an interest rate. It can also be a foreign exchange rate. But let's just keep it as price for today. Okay? So, it's denoted by X. All right. There are two parties to an options contract. Okay? However, we've got to think about it a little bit differently to forwards and futures. So if I can try and make you forget about forwards and futures for a while, that would be great. Okay? So, with an options contract, we will have a long position. Now, a long position is not what a long position is with a forward or futures contract. Okay? A long position with an options contract is giving one of the two parties in the contract the choice to transact at the exercise price. So let me say that a little bit clearer. If I'm in a long position of an options contract, I can choose whether I want to either buy or sell, depending on what type of contract I'm in, at the exercise price. So the person in the long position has the choice. Okay? It's got nothing to do whether you're buying or selling the underlying asset. It's only got to do with whether or not you have the choice to transact at the exercise price. Okay? So the farmer who wants to sell his wool, for example, if he wants to choose whether or not he wants to sell at the exercise price, he actually needs to be in a long position. Okay? So, even though he's selling the underlying asset, he's in a long position because he wants the choice to transact or sell at the exercise price. Can you see how that's different to a forward and futures contract? It's quite different. So the long position in an options contract is talking about whether the person has the choice to transact at the exercise price. Okay? So I'll write that down. Long position is the choice to exercise the contract and transact at X. Now you see how I put transact? Okay? That means it could be that I'm buying that asset or I'm selling that asset. Okay? So the long position with options contract is purely whether or not they've got the choice to exercise this option. Okay? Now, a long position with options can also be called the holder of the contract or the buyer of the contract. And the reasons for this will all be revealed at a later point. Okay. So, we have this person in the long position. They are the lucky ones because they can choose whether or not they want to transact at the exercise price. Yes? There's also the short position. And guess what? The short position has to do or has to comply with the long position. Okay? So if the long position decides to transact at the exercise price, the short position has to comply and either buy or sell at the exercise price. Okay? So the short position has to comply with the long position. Okay, so who's got the best deal here? Long position, because the long position's going to always have the choice, and they're always going to do what's going to make them the most money. Right? What happens to the short position? They kind of lose out. Yeah? Keep that one in mind. The short position's often called the seller of the contract, or the writer of the contract. Okay, so we've got these two positions, very different to our forward and futures contracts. If we want to be in a contract where the person who has the choice, the long position, wants to buy at the exercise price, we are in what's known as a call option. Okay? So if you're in a long call option, the person has the choice to transact at X for the underlying asset, but moreover, they have the choice to buy the asset for the exercise price. Okay? So that's what we call a long call option. So there are two types of options we need to know about to cover all the bases, so to speak. We need a call option and a put option. Okay, so let's break these down in a lot more detail. So the first type of option is a call option. Okay, and the second is a put option. Okay, now the call option is the right, but not the obligation, for the holder to exercise and buy at the exercise price. Okay, and this is where we're going to start getting a little bit confused, but we'll step through it and I'll repeat this over and over again. So in one call option contract, there will be two parties. There will be a long call and there will be a short call. Okay, now this makes up one call option. Okay? All right. So the person in the long call position has the right, but not the obligation, to exercise the contract and buy the underlying asset at the exercise price. Okay? The person in the short call position has to comply with the long call. So what that means is if the long call option is exercised, the short call has to sell the underlying asset to the long position at the exercise price. Okay, a bit tricky. Okay, so let me write this up. So the long call has the right to exercise and buy the underlying at the X for X. Or should I write for X? I should have done this. Okay. And I'll give you an example in a moment, or actually I'll ask you a question in a second. The short call has to comply with long call's decision. If long call exercises, short call sells for X. Okay? Right. So let's think of a scenario. We want to buy some wool. Yes? We're worried about wool prices going up. We want to buy low. What kind of contract are we going to enter into? Something we've got the choice. So what is that? A long position, right? We want to buy this wool, so we'll go into a long call option. What that means is we have the choice as to whether we are going to exercise the contract and buy this wool for X, or alternatively, we won't use the contract and we'll just go and buy it in the marketplace. Okay. When would we exercise? We would exercise when the exercise price is lower than the market price, right? Great. Think of the short call position. If the long call exercises, it means that the price is lower, the exercise price is lower than the market price. Is the short call doing well for itself? No, because they're selling the underlying asset, and all of a sudden they're forced to sell this underlying asset at a lower price than the market price. So the short call looks like it's not in a very good situation. Would you agree with that? I would think so at this stage. All right, so that's our long call, short call. That is one contract, right? What happens if we are selling wool? We would want to choose whether or not we sell for the exercise price or at the market price. Yeah? This contract, the call option, is not a contract we want to be in if we want to sell something and have the choice. We want to be in a put option. Okay? If we want the choice, is it long or short? It's long. So, essentially, with our put option, we will have two positions, long and short. With a long put, it will give the right to exercise and sell the underlying for X. The short put has to comply with the long put. Okay? And if the long put exercises, the short put has to buy the underlying asset for the exercise price. Okay, so therefore this here is one put option. Okay? And in general, a put option is the right, but not the obligation, for holder to exercise and sell the underlying for X. Okay? So, do you want to be in a long position or a short position? Long, yeah? Why? You get a choice, so you're always going to make a gain, okay? And then you have these people in the short position. What's their deal? Are they crazy? Maybe. Okay, we'll talk. Shh, don't spoil the surprise. Okay. The rest of the couple of these slides just basically go through exactly what we've just done. Okay, so just keep that in mind. A couple of other things we need to know about an options contract. Obviously, the underlying asset is specified, time to maturity is specified, whether you're in a call option or a put option will be specified. The quantity would also be specified, as in the amount of the asset. The other thing to note is what type of options we're dealing with. We can either have what's known as an American option or a European option. I always remember this by thinking, I shouldn't be careful. Americans like to have a lot of flexibility and choice, okay? You know, that's what they're known for. And so essentially an American option reflects this because an individual in the long position of an American option can exercise the contract at any point over the life of the contract up to and including expiration. Okay? Europeans, on the other hand, arguably could be a little bit more conservative and only allow at expiration. Okay? Now, question to you, you guys are all really smart. Which contract would have more value? The American. Why? Much more flexibility, much more choice. You can, as soon as it's making profit, you could exercise it. Okay? Now, if an options contract is making profit, as in the person in the long position, if they exercised, would make money, that's known as being in the money. Have you ever heard of that expression before? Not show me the money, in the money. Okay? If it's not worth exercising, it's called out of the money. And if the exercise price equals the market price, it's called at the money. Okay? So there's just some jargon you may have heard before, or you might recognize now when you read some of the financial press or blogs or whatever the case may be. Okay? So, we've done quite well. So we've done all that. That's all good. I'm just thinking what else I want to cover today because I want to save some for Friday. I've been a bit too efficient. Okay. You know what, guys? We're going to stop today and we'll reconvene on Friday. It's because I didn't do a big review at the beginning. It's only like 10 minutes. It's nothing amazing. If you have any questions, come and see me, but that's all I want to do. What we're going to start off on Friday is I'm going to test you with your positions in terms of forwards, futures, and options, so know them, okay? We're then going to talk about payoffs, and I'm going to give you an example which highlights the differences between a forward and futures contract versus options contracts, okay? So it's actually a really good example. So Friday, we'll do more, okay? Thanks, guys.
Lunch.
Oh, let me ask something.
不用我说，我操，你这么决绝的吗？笔仙不够当。
到时候我要买的话，我就是按照当时合同规定的那个价钱去买。
对，放在纸上就是旅行这个。
好烦啊！我每天压力好大呀。
我每次都忘记。 Okay.